The crisis has already started. In just 1 year, India became the largest buyer of Russian oil, over 1.7 million barrels a day, and almost none of it was paid in dollars. China's trade with BRICS partners in local currencies is up 15% year on year, and the World Gold Council says central banks bought 244 metric tons of gold in the first quarter of 2025 alone, the biggest surge in history. The US dollar isn't collapsing in headlines, it's eroding transaction by transaction. And here's the twist. The very tariffs meant to defend America's power are the accelerant driving the world to abandon it. The air in Rio is heavy. Motorcades line the avenue as leaders slip into the convention hall for a BRICS summit that feels less like routine diplomacy and more like crisis management. The world's largest emerging economies are forced into decisions they once hoped to delay. Tariffs are detonating supply chains, currencies are buckling, and central banks are preparing to live without the US dollar. Inside, India's delegation walks stiffly. New Delhi arrived carrying bruises from Washington's latest blow. In June, President Trump doubled tariffs on Indian exports to 50%. According to the Reserve Bank of India, more than $500 million exited the stock market in a single week after the announcement. Investors saw the double hit exports facing punitive tariffs and a currency slipping further against both the dollar and the yuan. China enters the conversation by default. India depends on it more than it admits. The Financial Times reported that Indian imports from China reached $125 billion in 2024, dwarfing the $18 billion India sells back. Dependency has grown by 76% in just 4 years. When Washington slams India with tariffs, the immediate consequence isn't closer ties with America. It's deeper reliance on Beijing. And then there's Russia. Moscow has become India's discounted lifeline. According to customs data, India has been importing 1.7 million barrels of Russian oil daily, surpassing even China's intake earlier this year. Almost none of it is priced in dollars. Reuters reported that most is settled in rupees or rubles, often at discounts between 5 and 10%. For Moscow, it's survival. For India, it's cheap energy. For Washington, it's defiance. But that survival bargain comes at a cost. India's exports to the US make up 2.3% of its GDP. Losing that market would hurt, but abandoning Russian oil would raise energy costs across industries, from fertilizers to transport. Both paths are dangerous. Neither is clean. The summit is supposed to weigh cooperation, but the arithmetic is brutal. Every concession comes with its own trap. Russia senses leverage. Bloomberg reported that negotiations over the Power of Siberia 2 pipeline could add another 6 billion cubic meters of gas to China annually. That gas would feed chemical plants, smelters, and electricity grids that already undercut global competitors. If India retreats from Russian energy to placate Washington, China won't hesitate to absorb the extra volumes. The outcome is predictable. Beijing grows more competitive. New Delhi pays more. Moscow doesn't lose a drop. At this point, the conversation widens. Because the tariff war isn't just hitting Asia, Canada has been thrown into the same fire. Statistics Canada reported that GDP contracted by 1.6% in the second quarter of 2025, nearly 3 times the expected decline. Exports plunged by 7.5%, car shipments fell almost 25%, and business investment shrank by more than 10%. Economists at Desjardins called it bluntly, the tariff war with the US was terrible for the Canadian economy. And here lies the connective tissue. Washington's strategy is fragmenting both rivals and allies. India is pushed closer to Beijing. Canada, a U.S. neighbor and longtime partner, is suddenly searching for markets across the Pacific. Carney's government shipped 300,000 barrels of oil to China in June, the highest in over a decade. But diversification isn't instant. Pipelines and ports aren't yet ready. Canada is trying to build escape routes while already bleeding. Then comes the hard stop. Let's pause here, because this wasn't supposed to be the real threat. For months, everyone assumed tariffs and sanctions were the tools to watch. But Deutsche Bank analysts warned in July that if the Federal Reserve ever restricts dollar liquidity during a crisis, de-dollarization could accelerate sharply. That line hit like an alarm bell. The danger isn't only tariffs, it's the possibility that the dollar itself can be withheld. If access is not guaranteed, then alternatives stop being optional. They become necessary. And with that, the summit's tone changes. Central banks are no longer debating hypotheticals. They're racing contingency plans. The World Gold Council reported that global central banks bought 244 metric tons of gold in the first quarter of 2025, the strongest start to a year on record. China alone purchased more than 27 tons. Gold isn't ideological, it's insurance. The IMF's July report showed the dollar still makes up 58% of global reserves. But in 1999, that figure was 71%. The slide has been steady, not sudden. Yet the symbolism matters. The euro is flat, the yen marginal. The only asset rising in share is gold. For BRICS leaders staring at their spreadsheets, the trend is unmistakable. But this isn't happening in a vacuum. Germany is also struggling. The OECD cut its 2025 growth forecast from 1.1% to 0.6%, citing weaker exports to China and tariff uncertainty with the US-German auto shipments to China dropped 12% in the first half of the year. Japan's Ministry of Finance, meanwhile, reported a record trade deficit in July as energy imports surged in cost and currency swaps with India and China were signed to avoid dollar shortages. The crisis is global. Still, BRICS can't yet deliver on the rhetoric. Reuters reported in June that discussions of a common BRICS currency ended without agreement. The Bank for International Settlements emphasized that cross-border payment systems take years of trust and infrastructure. The dollar system still dominates debt issuance, trade finance, and settlement. For all the talk, alternatives remain patchwork, yet patchwork becomes fabric. Brazil's President Lula told the summit that no nation should be held hostage to one currency. That's rhetoric, yes. But IMF data shows that by 2023, nearly 20% of oil trade was settled in non-dollar currencies, a record high. Small in percentage, enormous in precedent. The U.S. insists the dollar is unshakable. Treasury Secretary Scott Bessent told the Wall Street Journal that the dollar's depth, liquidity, and rule of law are unmatched. The evidence still supports him. But Bloomberg's commodity desk noted in May that 90% of Russian crude shipped to India was no longer settled in dollars. The dollar may be unmatched, but it is not universal. Canada, again, shows the paradox. CIBC economists forecast that the Bank of Canada will need to cut interest rates twice before year's end to cushion the contraction. Yet cutting risks further weakening the Canadian dollar, raising import costs, and worsening inflation. Every lever creates another vulnerability. It is a cycle no policy can fully escape. Mexico is in the same bind. The IMF estimated in August that U.S. tariffs shaved 0.7 percentage points off Mexico's second quarter growth, as auto exports to the U.S. fell 18%. Factories are adjusting, rerouting supply chains toward Brazil, which remains buoyed by domestic demand. Even within the Americas, old patterns are breaking apart. By the summit's close, the pattern is clear. BRICS did not launch a new currency. No gold-backed unit was unveiled. Yet, central banks are buying gold at record pace, trade settlements are shifting away from the dollar, and bilateral swaps are multiplying. Incremental changes stack. What once looked like isolated exceptions now form a widening trend line. The final projection lands with weight. The OECD warns that if tariffs remain through 2026, global growth could be cut by as much as 0.8 percentage points. That number reframes everything. It's not about whether BRICS moves fast enough or whether the G7 resists long enough. It's about whether the global system itself can withstand the stress of tariffs colliding with monetary fragmentation. But there's a quieter battlefield shaping the outcome. Payment systems. Reuters reported in July that China's cross-border interbank payment system, or CIPS, handled $19 trillion worth of transactions in 2024, a 25% increase from the previous year. By comparison, SWIFT volumes still dominate, but the growth rate of CIPS signals something important. Alternatives are no longer experiments, they're scaling. Russia has already plugged into that system. After being cut from SWIFT in 2022, Moscow shifted settlements into CIPS and its domestic SPFS. Bloomberg noted that by early 2025, over 70% of Russia's cross-border payments with China were being routed outside SWIFT. That shift doesn't just sidestep sanctions, it normalizes new rails. Meanwhile, Saudi Arabia signed an agreement with China in June 2025 to settle a portion of crude exports in yuan. The Wall Street Journal called it a symbolic crack in the petrodollar. The volumes are small for now, but symbolism matters when it's oil, the commodity that cemented the dollar's reserve status in the 1970s. The IMF has also flagged a surge in bilateral swap lines, the financial plumbing that allows central banks to trade currencies directly. China now has more than 40 active swap lines with foreign central banks, covering nearly $500 billion. Each swap line is a bypass. Each bypass reduces the habit of returning to the dollar. And the habit is what Washington fears most. Because once alternatives become routine, dollar dominance isn't broken in one moment. It erodes transaction by transaction until the old system simply looks outdated. And here's the irony. The United States defends the dollar with tariffs, sanctions, and restrictions designed to preserve primacy. But every act of defense forces others to test alternatives faster. What Washington builds to protect the system may be the very thing accelerating its replacement. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.